Highland PLC, a British-based company reporting in British pounds, established a Swiss subsidiary, Swazi Ltd, on 1st January 2016, with an investment of CHF 3 million. On that date, Swazi Ltd borrowed 2 million locally and acquired a factory for 5 million and machinery for 2 million. The draft statement of financial position of two companies at 31st December 2016 are given below. So the following is financial position of these two companies, and it also gives us three different exchange rate, which is first is rate on 1st January 2016. This rate, it's also the date of acquisition and money trading has been made. And the next is the rate on 31st December 2016. This rate is at date of close is the same date with closing date, okay? And also the third is average rate during 2016. And two requirements. The first sub-question is that to prepare a consolidated financial statement for Highlands Group using both temporal and net investment methods. The second is the second is differentiate between the following. So just discuss the difference between these two currencies. The first is local currency, functional currency, presentation currency. So I think let's start from the second question. The example, you have detailed example in your lecture, so we don't discuss that. The local currency usually is just the currency of country where the firm is based. It's decided by the currency where the country is based. Why it has a claim? Why it has made a note that usually it is a currency of country where the firm is based? Because that in some country, the legal currency it has in some country it has multiple legal currencies. For example, in some small countries, I know that they can use both British pounds, US dollar, and franc to trade, and all those currency are legistic in that country. Therefore, the local currency can be multiple. Sometimes it's not. Sometimes it's hard. Sometimes in some specific country, the local currency is not equal to where the country is based. But in most scenario, the local currency is equal to where the equal to the currency that the base country where the country is based. Okay, and the third is presentation currency. This is also very simple. This is a currency that the parent company used to make the financial reporting. So it is presentation currency is determined by the parent company's financial report. Local currency mostly is determined by the country where the company is based. Okay, and the only one hard to determine is functional currency, and it has 6 key points how to select the functional currency. The functional currency means the currency of the primary economic environment, which means that most of your transaction have been made in this currency, in functional currency. It has 3 key points. How to decide primary economic environment. It has 6 points, which is the currency that mainly influence the sale price of its products, the currency of the country where competitive forces and regulations mainly determined, blah, blah, blah. And the currency that mainly influence the labor, material, and other costs. The currency that mainly influence the funds, you raised, the currency that mainly influence receipts and also the costs. So in your lecture, it has a very detailed discussion on those three key points. You just combine with your lecture and have a detailed discussion on these three different concepts. You first introduce what does local currency represent for, what does presentation currency represent for, functional currency represent for, and then you have a detailed discussion on how to select each of those currencies, like how to select local currency, how to select functional currency. And the only currency that a little bit complex is functional currency. Other presentation currency is very, the selection is very straight, okay, very simple, very straight. So after the second, let's discuss how to prepare the consolidated financial statement of this Highlands Group. So basically, you need to translate the subsidiaries' financial report, the statement of financial position from CHF, which is Swiss franc, to the British pounds, right? You need to make a transaction or translation. You need to make the translation from CHF to the British pounds. And they have two methods, temporal method and net investment method. And so the only difference between these two methods are monetary assets or non-monetary assets. Let's see. This page is cut from your lecture, and functional currency translation exchange rate, presentation currency exchange rate. So the only difference is that in the functional currency translation exchange rate, the non-monetary asset and liabilities is translated at historical rate or rate at date of revaluation. Except this rule, all other rules, at least at financial position, is similar. Okay, these two methods, like temporal method and net investment method, are similar. So let's first discuss the temporal method, which is also use the functional currency translation exchange rate to calculate or to translate the financial statement of financial position in temporal method. You need to first decide which item belong to the monetary asset, which item belong to the non-monetary asset, and just following these rules. Like monetary assets are translated at closing rate, non-monetary assets are translated as historical rate, share capital translated at ruling date or acquisition date. So reserves are translated at the date originally recognized or date of acquisition. Okay, so let's solve these questions. The first we use temporal method, and the Highland PLC. All these figures are directly copied from above, and Swazi Ltd. I have also copied in here by the CHF, count by the CHF. I have also calculated by the at here, and the first step we need to separate the assets to monetary assets and non-monetary assets. So first, factory obviously is non-monetary assets, machinery non-monetary assets, inventory non-monetary assets, trade receivable because of its high liquidity assets, and also because trade receivable usually it's some it's valued directly by the money. So it's valued directly by the currency. It's count directly by the currency. So the trade receivable is regarded as monetary asset, when the receivable is regarded as monetary asset, because the receivable and payable, they usually have the same liquidity and same form. So the payable also regarded as monetary asset. And also bank, sometimes it has different name. It's cash and cash equivalents. So of course this item is monetary assets. The only one you need to make a note is that long-term loan. Although long-term loan exists as a form of currency, but it is not belong to the monetary asset. Okay, long-term loan is belong to the non-monetary assets or liability. So the only three items, trade receivable, bank, and trade payable, belong to the monetary asset in this question. So following the rules of temporal method, non-monetary asset, how do we translate them? We translate them by the rate of by the historical rate, right? And let's say factory, both the factory and long-term loan, factory are bought at the acquisition date, which is the 1st January, and also loan is raised at the acquisition date, which is also the 1st January, right? So compare with the table that of exchange rate given in the question. 1st January, the 1st January, the exchange rate is equal to 4, which means that 1 pound equal to 4 CHF. So the factory is 4, right? The historical rate is 4. You know, we use 4 to translate the factory. It is because that the factory is bought at that day. It's not because of we use the opening. We use the opening exchange rate. It's just because the transaction or the trading are made in that day. Okay, and the machinery we use 4. Current assets, inventory. The inventory here, you need to make a note. We need to, following the rule, the inventory is belong to the non-monetary asset, right? And therefore, we need to use the historical rate to calculate, to translate the inventory. Is that clear? Inventory first is belong to the non-monetary asset, and then we need to use historical rate to calculate or to translate the inventory, right? So what is the historical rate of inventory? Here is a second key point. The first key point is which item belong to the monetary asset, which item not. Okay, which item belong to the non-monetary asset. This is the first key point. And second key point is that how to determine the historical rate of inventory. Because for factory, it's very simple. It tells you that the factory spent 5 million and is bought at the 1st January 2016. And we know the historical rate at that day is equal to 4, right? But we don't know at what date we bought our inventory and what is the exchange rate at that day, right? At that day. So should we use 4 as historical rate, or should we use 3, which is closing rate at historical rate? You need to think this question. What is the historical rate of inventory? Anyone has some thoughts? Anyone? What is the historical rate of inventory? Yeah, you need to use the average rate to calculate. Why you need to use the average rate? Because actually, the average rate didn't represent anything. Okay, because in the rule, let's say, let's go back to the rule. In the rule, suggested how to calculate the statement of financial position. none of these rules that tells you that you need to use average rate to calculate the. None of these rules suggested you need to use the average rate to calculate anything. It is neither the closing rate or the rate at acquisition date, right? So, but why here when we calculate inventory we need to use average rate? It's because of we don't have detailed information of like in what specific day we made the trading of inventory. Therefore, actually we have an implicit assumption that we assume the inventory are bought smoothly during this financial period. Like each day I bought the same amount and it is smoothly. Why we have this assumption? Because like for example, if all inventory are bought in one day, then the exchange rate in that day will be more important than the average rate. Only when the inventory are bought smoothly during this financial period, we can use the average rate of exchange rate to represent the historical rate, right? Because when we assume the inventory are bought smoothly during this financial period, then the average cost, the average historical rate of inventory is equal to the average rate of, is equal to the average exchange rate, right? You need to remember because it is a very detailed, rule, but you really need to remember that, okay? We use average rate to calculate inventory. It's not because the rule requires us to do so. It's just because we assume the inventory trade smoothly during its financial period. Therefore, the average historical rate of inventory is equal to the average exchange rate. Therefore, we can use 3.5 to represent the historical rate of inventory, okay? And the trade receivable, because it's monetary asset, we don't need to discuss. We use closing rate, right? As a rule requires us to do so. And bank, 3, trade payable, 3, long-term loan, we use the historical rate. And following the question, the loan are raised at 1st January, so the historical rate is 4, right? The share capital, we use the rate of acquisition, and it's 4, right? Because it's 1st January. The acquisition are made in the 1st January 2016, and profit for the year. So this is also hard. Following, you compare the discussion of inventory, which rate we need to use to calculate the profit for the year. Anyone tells me? It has a very similar concept with inventory, because we don't, let's see, 3.5, yes. So because we don't know the exact date that we get our revenue or we accept the cash from our customers, therefore we assume that the revenue are made smoothly during this year. So we use 3.5, which is the average exchange rate, to represent the average historical rate of profit, okay? So, but here we have another question, okay? Like we have another problem. Like when you calculate the depreciation is following the assets value, right? When the assets value are translated by 4, so the depreciation will also be translated at 4, right? So, which means that before the translation, if you see the first, if you see it all by CHF, before translation, the profit for the year is calculated by the CHF, right? So, which is basically at the closing value, right? When you translate the profit, when you calculate the profit for the year by CHF, for example, in income statement, we got the revenue, right? Revenue is by XXX by CHF, count by CHF. right? CHF. Revenue is XXX, count by CHF, right? Deduct the depreciation, right? The depreciation. We use the revenue, deduct the depreciation, for example, also XXX CHF, to calculate the profit, right? So profit is equal to 970. Is that, and the depreciation is equal to 500 plus 50. So it's 550 by CHF, right? So if we use this profit to times to divide it by 3.5 to calculate the profit. So what does that mean? That means we actually, the revenue is, if we translate the income statement as well, the revenue is divided by 3.5, right? The rate of 3.5, and also the depreciation is divided by is translated by the rate 3.5. So therefore, the profit can be translated by the rate 3.5. So if we directly use profit 970 divided by 3.5, we got this 970 divided by 3.5 is equal to 277, right? 277. But that means the depreciation we used to calculate profit is also divided by 3.5. The real the depreciation in British pounds is 550 divided by 3.5 is equal to 157, right? But here actually, if you go back to the assets part, the accumulated depreciation is translated by 4. It's not by 3.5, right? Okay, let's repeat because my express might not very clear. Although the profit for the year, we should use 3.5 to calculate, but what this 3.5 actually represent for is that the revenue and all the costs are, continuously or smoothly made, and we can use 3.5 to translate revenue. But the problem is we can't use 3.5 to translate depreciation because in the temporal method, we say we need to use 4 to translate the assets, to translate the depreciation value, right? So therefore, we need to make an adjustment. We first calculate the profit before depreciation, which is use 970 plus 550 and divide by 3.5 is equal to 477, and use 477, which is translated profit before depreciation in British pounds, which what is this 477 represent for, and minus the real depreciation in British pounds, which is 175, calculated because the translate rate is 4. After that, we got the real profit for the year is equal to 302. Okay. The real profit increased. It is because we have adjusted the depreciation. We need to make an adjustment of depreciation. Okay. So after we made the adjustment, so this is a key point. You just remember, okay, in the temporal method, when you use temporal method, you need to adjust the profit for the year. It is because the it is because the assets are valued by the historical rate, but the profit, when you calculate the profit, it is by the average rate. So you need to make an adjustment, and this is a third key point. Okay, and when you determine all the interest rate, and you just calculate and you just translate the Swazi LTD from CHF to British pounds. You use 5,000 divided by 4, for example, is equal to 1,250, and 500 divided by 4 is equal to 125. 2,000 divided by 4, sorry, this is negative because it's depreciation. You need to make yourself notice. And 2,000 divided by 4, 500, 50 divided by 4, negative 50. Sorry, this is negative 200. This is negative 200. Okay, and so all other items are similar, like infantry divided by 3.5. So basically all items are the similar, and now you have translated the Swazi Ltd's financial position from CHF to British pounds, and the next step is to prepare the consolidated statement. And how to prepare the consolidated statement is just like we have discussed in the previous tutorial, but in this question it's much easier because we don't need to adjust any any additional information, and the only thing you need to pay attention to is that you need to cancel this investment account, and also if the current assets and the liabilities, if these two company has some credit for each other, you need to also cancel those items. So that is the only thing you need to pay attention to. Okay, and to calculate the consolidated statement, very simple. You just plus the value of, for example, the value of factory of Swazi Ltd with Highland PLC, and is equal to 2,750. So all other items are simple. Are same. You just plus the value of these two. The value of each item of these two companies, and you got the consolidated. You got the value of the Highland group of this item. The only thing you need to pay attention is that if you calculate the net value here, it's equal to 941. But when you calculate the net assets of the Highland group, you can't directly plus 941 with 3,070 to calculate the group net assets value, right? Because that you have canceled some item. You have canceled 750. Therefore, although the consolidated statement, the items in consolidated statement is just a plus of the separated item, but the net assets in this integrated accounts, you can't directly sum these two two figure to calculate the total net asset. It is because you have canceled some item. Okay, you need to calculate the total net assets by the I calculate each item of the assets and the liability. Okay, so that is the first key point, and the fifth is that share capital, you don't need to plus the Swayze Ltd with the Highland PLC. Just as we have discussed in the previous tutorial, you only use the share capital of parent company to represent the share capital of the Highland Group, which is 2,200. Okay. I forgot to tell you how to calculate the translation adjustment, because when you made a translation, sometimes it's, for example, because of the fluctuate of the exchange rate, the company's revenue might, the exchange rate, the fluctuation of exchange rate might also generate some profit for the company. You all know that, right? So sometimes when we translate the foreign currency to the presentation currency, it also generates some profit or loss by the different exchange rate. And how to calculate that is that we first calculate the total net assets, and because the total net assets equal to the total equity, so the total net assets equal to 941. Therefore, the total equity equal to the 941. And after you calculate, after you translate the equity, and the share capital 3,000 divided by 4 is equal to the 750, right? And the profit for the year is equal to the 302. So you see the sum of this two items, which is total equity, is equal to the 1,052. It's not equal to the 941, right? So you need make an adjustment at this accounts to make sure that the total equity is equal to the total net asset. Basically, is to make the balance sheet still balanced. And how to calculate this accounts is use 941 minus 750 minus 302, and you got is equal to the negative 111. So the translation adjustment is equal to the negative 111. Okay. So that is all about how to preparing the consolidated financial statement of consolidated financial state position of the Highland Group, okay, by temporal method. Do you have any questions? Yeah. You long-term loan, right? Yeah. I think you just make a note that although the long-term loan, it is valued. I know you have included the long-term loan to monetary asset, right? Yeah, I know that long-term loan, it is valued by the currency. It is so it's very similar to like monetary asset, but what actually separate monetary asset and non-monetary asset, the most important rule to separate monetary asset and non-monetary asset is by the liquidity of those assets. Okay, let me repeat. The most important rule to separate monetary asset and non-monetary asset is by the liquidity. So although the long-term loan are valued by the currency, but because it's long-term loan, it's low liquidity asset. So we regard it as non-monetary asset. For example, let me give you an example. Like if there has in current assets, we have a specific item that is gold. So it should belong to the monetary asset or non-monetary asset. Anyone tells me? If we have gold, it should belong to the monetary assets or non-monetary assets. Anyone? No, it should belong to the monetary asset. Why? Because gold is kind of high liquidity assets, and although, for example, it might valued by ounce, or it need to be traded in the market to become cash, but because it's high liquidity assets, so I could only say in most scenarios, the gold should belong to the monetary assets. Okay. So, let me repeat the most important category, I think, to separate monetary asset and non-monetary asset is based on the liquidity. Okay. So that is why the long-term loan, although it's valued by currency, but it belongs to the non-monetary asset. Okay, is that clear? Okay. Let's move on to net investment methods. First, let's say the let's say the rule. The net investment method is much easier than the temporal method because we don't need to separate non-monetary asset and monetary assets. In the net investment method, we translate assets and liabilities at closing rate, all at closing rate. So actually, it's much easier than before. So factory 3, because it's we translate at closing rate, right? Machinery 3. Infantry, although the infantry has different, the infantry are bought at many different dates, but all the infantries we are translate at closing rate. So for infantry, for infantry we also use closing rate to translate at, and trade receivable, because we don't separate monetary asset and non-monetary asset anymore. So trade receivable 3, bank 3, trade payable 3, non-current long-term loan 3. Okay, and equity share capital is the same with before. It's 4 and 3.5. 3.5. Okay, and it is very simple. The only I think the only hard point is profit for the year. Honestly, to tell you that when I calculate the profit for the year, I made the adjustment like what we do in the temporal method. I think because the depreciation are calculated at closing rate, right? But profit for the year is calculated by 3.5. So I think we need to make an adjustment as well. But in suggested solutions, when we use net investment method, we don't make such adjustment. Okay, let's repeat. We don't make such adjustment. So I have sent an email to Dr. Gabriel, and this is his reply. And so he told me that under net investment method, both asset and depreciation are translated at closing rate, hence no adjustment is required. So I think my interpretation is that although the profit for the year has the same figure with before, but in net investment method, the method to calculate the profit for the year actually has changed. Okay, so therefore, although the assets is like calculated at depreciation value, which is 3, but we don't need to make any adjustment. So honestly, this part, personally, I still have some confusing, like why we don't make an adjustment. Yesterday I have trying to solve this question until 3 o'clock, but I still have questions. I think you guys just remember, okay? In net investment method, we don't make an adjustment, but in the temporal method, we made an adjustment. Personally, my interpretation is that the profit for the year, when you calculate the profit for the year in net investment method, is also by some specific rule. Like if we say translating like this is the first is temporal method, and second is net investment method, right? Let's say the income statement translate revenue and expenses rate on date earned or incurred. So these three are the same, but in the net investment method, it has a specific detail that depreciation is allocated for a period, so may use average rate. So I think, okay, it is because that in net investment method, the profit for the year are already calculated by the depreciation in the profit for the year are already calculated by the closing rate. Therefore, we don't need to make any adjustment. So that is my interpretation. I'm not sure if that is correct. If you still have such trouble, I recommend you that in the next QA session, have a discussion with Dr. Gabriel, because I didn't have a discussion with him. I just sent him a letter because we don't have enough time. So personally, I didn't solve this question for myself. So to you, I can't explain more details. I think just remember we don't make an adjustment. So this is a key point. Profit for the year, very important. All other item is very simple. Other item you just use closing rate to calculate them, and after translate to the British pounds, next step is calculate the consolidated statement. It's still same with before. Okay. The value of the translated financial position will be different, but it's a common thing, okay? Because you are using the different method to translate the CHF to British pounds, it's reasonable to have some difference of the total value. So that is all for today. Do you have any questions? Okay. So just pay attention to this, okay? I think if you can't understand, the most simple way is just remember. Personally, I don't know the logic, but I think just remember the profit for the year in the net investment method. You don't need to adjustment because, as Dr. Gabriel said, under net investment method, both the assets and depreciation are translated at closing rate, hence no adjustment required. Okay. Let's just remember that. Okay. Do you have any questions? If I can solve? Could you explain how to get the translated value of profit for the year again in the first method? Okay. So how to get the profit for the year is first, so first you understand the concept that why we need to make an adjustment. It is because that when we calculate the profit for the year, we use 3.5. We use the average exchange rate to translate the profit for the year. But actually, the depreciation are translated at historical rate, right? So, we use average rate to translate profit for the year, but profit for the year is calculated by the revenue deduct the depreciation and deduct many other items. And if we use 3.5 to calculate the profit for the year, which that means we also use 3.5 to calculate the accumulated depreciation. That will make our balance sheet unbalanced. Therefore, we need to make an adjustment. So the first, we calculate the profit before depreciation. Like if you use this table, profit for the year is 970, and depreciation is 700, right? 700. So profit before depreciation is 1,600. Sorry, profit before depreciation. Okay, 1,670. 70, right? 70, yeah. 1,670. After calculate the profit before depreciation, you use profit before depreciation divided by 3.5 and minus the depreciation expenses, which is a real depreciation expenses, is divided by 4. So the profit for the year is equal to the 302. Okay? Is that clear? Okay. It has some specific details, like you know it has some small details you need to pay attention to. Like in temporal method, you need to pay attention to. First is how to calculate the inventory. What is the inventory's translate rate, and the second is what is the translate rate of profit. And also you need to know that you need to cancel some specific items like investment to prepare the consolidated statement. And you need to prepare the translation adjustment. This is also a detail to make the balance sheet balanced. Okay, if you forget this adjustment account, then your balance sheet will be unbalanced. Like here will be equal to 941. Here will be 1,000 something. So you just remember you need to make an adjustment here. So and also how to separate the monetary asset and non-monetary asset. Okay, so that is some detail. I recommend you that to try to solve this question by yourself. To help yourself understand those details. And the net investment method is much easier because all the closing rates, all the assets and liability are translated at closing rate. But the only thing you need to remember is that profit for the year you don't make an adjustment. You directly use 3.5 to translate the profit for the year. Okay. If you want to solve this question, you can come to the tomorrow's tutorial. I think today I will try to solve this question again. I will try to understand the logic of this question. So maybe tomorrow's tutorial I will have a detailed explain. But today I didn't solve this question. I didn't build a logic to myself. So I could only say that we need to remember we don't make an adjustment here. Okay. So that is all for today. Thank you for coming. If you want to understand the logic of that profit for the year, why we don't make an adjustment, you can come to the tomorrow's tutorial. I'm really sorry for you guys. So that is all for today. Thank you for coming. Thank you.